From our studios in Atlanta, this is CarBiz Today.
Hello everyone and welcome to the Kerrigan Advisors Market Update for October. I'm Bridget Fitzpatrick. Here to talk about this month's market update is Erin Kerrigan. Erin, thanks so much for joining us today.
Thank you, Bridget, for having me.
All right, how did the Kerrigan Index do for October?
So for the month, not surprisingly, the Kerrigan Index was down 7.7%. It was down in line with the S&P 500. We all know that the stock market has been pretty volatile over the last month.
Were any stocks up in October?
Interestingly, Lithia was up 7%. So Lithia was the only stock in the index that was up for the month. And we think that's really an indication of investors' support of Lithia's strategy, not only to grow through consolidation and acquisition, but also their investment in Shift. Lithia talks a lot about using that investment to support their entire dealer network, and it seems like investors believe that'll be a profitable strategy.
And tell us about what you expect for the buy-sell market in the third quarter.
So we're just in the throes of finishing up our third quarter blue sky report, and we see another quarter of a very active market. We expect 2018 will be the fifth consecutive year of over 200 transactions, which means that in the last 5 years, we've seen over 1,000 transactions in our market, or about an eighth of the dealer body change hands.
What are some trends that you're seeing in the buy-sell market?
So some of the trends that we discuss in the report are certainly about why we have more sellers coming to market and the nature of the transactions we're seeing. Specifically related to sellers, we've done a lot of analysis looking at the generational shifts in our industry. And so not surprisingly, because we are such a family-run business, we are seeing more and more dealers hitting up against those generational shifts. And dealers really think in, I like to say, generations, not even decades. And when they look at the next generation that may be in their 20s or 30s and they're thinking about taking over these growing businesses, some families are deciding, maybe we don't want to pass this business down to the next generation because it's going to be perhaps a more difficult few decades if the industry is undergoing a lot of change. It's important to keep in mind that only about 30% of businesses make it to the second generation, 12% make it to the third, and 3% make it to the fourth. So with those statistics, it's really not surprising that our industry is seeing more families as they bump up against those generational changes to decide, especially given the market's potential changes in the future. Again, we don't know what's going to happen, but we certainly expect some changes to retailing, that these families are deciding maybe this is the time to exit.
That's why more sellers are coming to market, but what's going on with the buyers?
So another reason sellers are coming to market is because there are buyers. There are a lot of buyers. And the reason there are so many buyers is for the same reason that sellers are deciding maybe this is the time to exit because we think there's change coming and we think we need more scale and we don't really want to grow more and risk our capital. The buyers are the opposite. The buyers are excited about the change. They're excited about the opportunity to consolidate this industry that is the most fragmented industry in terms of retailing in the U.S. It's a $1 trillion industry, so it's not only the most fragmented, it's also the largest retailing industry. And buyers see an opportunity to really ride the wave of innovation and actually grow their earnings profitably, both through consolidation and again through some of the changes we expect. They expect to be very profitable and lucrative for them.
Are you seeing buyers access outside capital?
We are seeing buyers access outside capital. We actually have seen them not only look to the equity markets and family offices, private equity firms to grow their groups, but also the debt markets. A notable transaction for the quarter is the Ken Garff Automotive Group's decision to go to the bond markets to raise over $375 million to buy out their equity partner, Leucadia. Now that transaction was unique in that that was the most money that we can think of a private dealership group raising in the bond markets. So it shows that the investment community is willing to invest in auto retail and in the consolidation strategy. And what was interesting about that transaction is it will be, we think, the largest transaction of the year with over a $600 million enterprise value.
And how do you see rising interest rates affecting transactions?
So we are definitely in a rising interest rate environment. We're all well aware of that, and that has an effect on auto retail. It's important to keep in mind that part of the reason that interest rates are rising is because the economy is doing so well. So that is a counterbalance. In general, as it relates to transactions, as interest rates rise, typically buyers and investors do have higher costs of capital, meaning the cost of borrowing money goes up, and therefore the amount they are willing to pay for a dealership's earnings often does then go down. So we do expect in the future we will see some pressure on blue sky multiples if interest rates continue to rise. But it is important to keep in mind that, again, it's not across the board, and it does take some time for rising interest rates to affect valuations. So we have yet to see it today, but we do expect in the future that it will have some negative effect on valuations.
Erin, thanks so much for joining us today. We look forward to catching up with you next month.
Thank you so much for having me, Bridget.
CBT Automotive Network, the #1 most watched network in retail automotive.